Just now, the Federal Reserve did something it has only done 7 times in its 110-year history. It announced an emergency interest rate cut outside of a scheduled policy meeting. No warning, no press conference, just a single statement released through the Federal Reserve wire system that sent shockwaves through every trading floor on Wall Street. Within 90 seconds, the Dow Jones Industrial Average dropped 847 points. The S&P 500 plunged 3.2%. Treasury yields spiked to levels not seen since the 2008 financial crisis. But here's what makes this truly unprecedented. The Fed didn't cut rates by a quarter point. The usual move. They slashed rates by a full percentage point in a single emergency action. And the statement that accompanied it contained just 3 paragraphs. No explanation, no economic data, no reassurance. Just cold technical language that left traders, analysts, and economists asking one terrifying question. What does the Federal Reserve know that we don't? Stay with me until the end, because what happened in the 48 hours leading up to this decision reveals a financial crisis that's been building in silence. And the emergency measures being taken right now could reshape the American economy for the next decade. To understand why this emergency rate cut is so shocking, we need to go back exactly 48 hours to Monday afternoon at 4:47 p.m. Eastern Time. That's when the first cracks appeared. A regional bank in the Midwest, one you've probably never heard of, failed to meet its overnight liquidity requirements with the Federal Reserve. In simple terms, it didn't have enough cash on hand to cover its obligations. This happens occasionally. Usually, the bank borrows from other banks through what's called the federal funds market. But here's the problem. No other bank would lend to them. Not at 5%, not at 7%, not even at 10% interest. That's when the Federal Reserve's emergency lending facility, something called the discount window, got activated. By 11 p.m. Monday night, 3 more regional banks had quietly accessed emergency Fed lending. But the public didn't know any of this. Markets opened Tuesday morning with no headlines, no panic, and no awareness that the banking system was under stress. The Dow opened up 127 points. Traders were optimistic. Analysts on CNBC talked about a soft landing for the economy. Everything looked fine on the surface, but behind the scenes, something else was happening. According to sources familiar with the matter, Federal Reserve Chair Jerome Powell began making calls to the heads of the nation's largest banks, J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo. These weren't routine check-ins. These were emergency consultations. The question Powell was asking, how much exposure do you have to commercial real estate loans? Commercial real estate, office buildings, shopping malls, hotels has been struggling since the pandemic. With remote work becoming permanent and retail moving online, property values have collapsed in many markets. Banks have been quietly absorbing these losses, hoping the market would recover. But by Tuesday afternoon, it became clear the losses were far worse than anyone publicly admitted. Treasury Secretary Janet Yellen joined a secure video call with Powell and the heads of the Federal Deposit Insurance Corporation and the Office of the Comptroller of the Currency. The topic systemic risk. That's a term that only gets used when regulators believe a crisis in one part of the financial system could spread rapidly to the entire economy. It's the same term used in 2008 before Lehman Brothers collapsed. The Federal Open Market Committee, the group of Fed officials who set interest rates, was adjourned for an emergency, closed-door meeting scheduled for Wednesday morning at 8 a.m. Emergency FOMC meetings are extremely rare. The last one was in March 2020 when CO-19 shut down the economy. Before that, it was September 2008 during the financial crisis. When the Fed calls an emergency meeting, it means the situation is urgent, serious, and cannot wait for the next scheduled meeting 6 weeks away. 12 Federal Reserve officials gathered in the boardroom at the Eccles Building in Washington, D.C. Regional Fed presidents joined via secure video link. The agenda had only one item: whether to cut interest rates immediately to prevent a banking crisis from spreading. Here's the calculation they faced. Option 1, do nothing. Wait until the next scheduled meeting in 6 weeks. Hope the liquidity problems resolve themselves. Avoid panicking the markets with an emergency cut. The risk: if banks continue struggling to meet their obligations, depositors might lose confidence and start withdrawing money. That creates a bank run. Bank runs create failures. Failures create contagion. Option 2, cut rates by 0.25%. A small cautious cut that signals the Fed is monitoring the situation but doesn't believe things are critical. The risk markets might interpret a small cut as a sign the Fed doesn't understand the severity of the problem. Banks might not get enough relief to stabilize. Option 3, cut rates by 1%. A massive emergency cut that floods the banking system with liquidity. Makes it cheaper for banks to borrow from each other, and from the federal signals the Fed is taking decisive action. The risk markets might panic, thinking, if the Fed is cutting this much, how bad are things really? After nearly 6 hours of debate, the committee voted. The decision was not unanimous. 3 members dissented, arguing the cut was too aggressive and would create inflation problems later. But the majority agreed. The threat of a banking crisis was too severe to wait. The rate cut would be 1% 0%, dropping the federal funds rate from 5.25% to 4.25% immediately. The Federal Reserve issued a statement through its wire system. In light of evolving financial conditions and risks to economic stability, the Federal Open Market Committee has voted to lower the target range for the federal funds rate by 100 basis points, effective immediately. The committee will continue to monitor developments and is prepared to take further action as appropriate. That was it. No press conference, no Q&A with reporters, no detailed explanation. Just 3 sentences that confirmed the Fed was intervening in an emergency. Trading algorithms detected the Fed's statement instantly. Within seconds, sell orders flooded the market. Why would stocks fall if the Fed just cut rates? Isn't that supposed to be good for the economy? Here's the counterintuitive truth. Emergency rate cuts often cause panic because they signal the Fed sees danger that markets haven't fully priced in yet. Traders immediately started asking, what does the Fed know about bank balance sheets that we don't? How bad is the commercial real estate crisis? Are we heading into a recession? The Dow Jones dropped 847 points in 90 seconds. U.S. Treasury bonds, normally the safest investment in the world, started behaving erratically. The yield on the 10-year Treasury note, which moves opposite to price, spiked from 4.15% to 4.61% in minutes. That's a massive move that signals investors are demanding higher returns to compensate for risk. Translation: even after the Fed's emergency action, bond investors are pricing in serious economic trouble ahead. Shares of regional banks, the ones most exposed to commercial real estate, plunged. First Republic Bank down 18%, PacWest Bancorp down 22%, Western Alliance down 19%. These are the same names that struggled during the March 2023 banking crisis when Silicon Valley Bank collapsed. The market is signaling it fears a repeat. Bloomberg, CNBC, and Reuters all interrupted regular programming with breaking news alerts. Analysts began speculating. This looks like 2008 all over again. The Fed wouldn't cut this aggressively unless something serious is happening behind the scenes. We're probably already in a recession and just don't know it yet. By the closing bell, Dow Jones was down 24 points, 3.1%. S&P 500 down 3.5%. Nasdaq down 4.2%. It was the worst single-day performance since March 2023. Here's what makes this situation so dangerous. The Federal Reserve statement gave almost no information about why they took emergency action. That silence is deliberate. The Fed doesn't want to name specific banks or sectors because doing so could trigger the very panic they're trying to prevent. But by analyzing Federal Reserve data released weekly, we can piece together what's really happening. U.S. banks are holding approximately $2.9 trillion in commercial real estate loans. According to recent estimates, 20 to 30% of office buildings are worth significantly less than their loan values. $1.5 trillion in commercial real estate loans will mature between now and 2025. Many property owners won't be able to refinance at current interest rates. When property owners can't refinance, they default. When they default, banks take losses. When banks take losses, they reduce lending. When lending contracts, the economy slows. Large banks like JP Morgan and Bank of America are relatively insulated. They have diversified loan portfolios and massive cash reserves. But regional banks, the 4,000-plus smaller institutions across America, are heavily concentrated in commercial real estate. Some have 40 to 50% of their loan portfolios tied to office buildings and retail properties. If those loans start defaulting in large numbers, regional banks will face capital problems. That's exactly what happened in March 2023 with Silicon Valley Bank. The Federal Reserve isn't just worried about individual bank failures. They're worried about systemic contagion, the risk that problems in regional banks spread to larger institutions, freeze credit markets, and trigger a recession. That's why they acted so aggressively. They're trying to prevent a 2008-style financial crisis before it starts. Over the next 30 days, watch for 3 specific developments that will reveal whether the Fed's emergency action worked. First, bank earnings reports. Major banks report quarterly earnings starting next week. Pay close attention to commercial real estate loan delinquencies, provisions for credit losses, and management commentary about economic conditions. If banks are setting aside significantly more money for potential losses, it confirms the Fed's concerns. Second, Fed discount window usage. The Federal Reserve publishes data every Thursday showing how much banks borrowed through the emergency discount window. If borrowing stays elevated or increases, it means banks are still under stress and can't access normal funding markets. Third, Treasury and Fed statements. If Treasury Secretary Yellen or Chair Powell schedule a public appearance within the next week, it signals they feel the need to calm markets and explain the situation. Silence, on the other hand, might mean they believe the emergency cut was sufficient and don't want to draw more attention to the problem. The Federal Reserve doesn't make emergency rate cuts unless they see serious danger. The fact that they acted so aggressively, cutting rates by a full percentage point outside a scheduled meeting, tells us this situation is worse than what's being reported publicly. This isn't about inflation anymore. This isn't about a soft landing. This is about preventing a financial crisis. The system isn't broken yet, but the Fed just confirmed it's under severe stress. And the most important question isn't what the Fed did today. It's whether what they did was enough to stop what's coming next. The answer to that question will determine whether we look back on this as a successful intervention or the beginning of something far worse.